Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you want to book a free call to discuss your personal situation.
Welcome to another episode of the Brokers Lounge with Carlo and Eddie. In this episode, we'll be talking about different structures with your mortgage, things to consider such as fixed rates versus variable rates, the pros and cons of each, principal and interest repayments versus interest-only repayments, the pros and cons of each, and we'll try and touch on purchasing in your personal name versus a trust name. So we've got a bit to cover.
Lots to unwrap.
Yep, so let's get to it. Carlo, how are you?
I'm doing very well, thank you, Eddie. It's the end of another week, and it's been a super busy week. It feels like the market's starting to turn a little bit, and
Yes.
a little bit more confidence getting back into the market, which is good news, obviously from our point of view as well. So it's been an interesting week for me personally. Unfortunately, I had a funeral to attend to yesterday of a very close friend, but I guess if you want to take the positives out of it, it does put life into perspective for you and makes you realise, what are the important things in life and never take things for granted. And
Absolutely.
I have a bit of a saying that we're not here for a long time, we're here for a good time. So that's been my week. Maybe a little bit depressing, but it's good from a perspective point of view. And yourself, Eddie, what's happening this week with you?
Usual, no funerals, but I know you've had a tough couple of weeks with your mate passing away, and like you said, just brings us back to what really matters in life, and just take it one day at a time and try to enjoy it as much as we can. We go through tough periods, and just the global vibe is not great at the moment, but just try to stay positive and push through it and hope for the best.
Yes, exactly right. So, so I guess we'll get into it, and
let's get to it.
As Eddie mentioned, we'll talk about choosing the most appropriate loan for yourself. And one of the first things we do get asked is, do I go with a fixed rate? Do I go with a variable rate? And it's a good, valid question, and it's an interesting one at the present moment, where there's still a lot of uncertainty around where rates are actually going to be going. You've got some economists who are talking about a rate cut potentially before the end of the year. Some are talking early next year. You speak to the RBA and they're like, never. So it's a bit of a tough choice for people to make in terms of whether they go with fixed or variable. But I guess if we look at fixed rate loans first, there's lots of pros and cons with fixed rate mortgages, and I guess if you look at the pros first off, maybe you can run through some of the downsides to it as well. The first one that comes to mind is obviously giving you that certainty around your repayments.
Yes.
And I think that's so important when clients are actually asking you whether to go with fixed or variable. I quite often throw it back to them and say, well, do you need a lot more certainty around what your cash flow looks like? Because for me, that's very important. And if there's an element of anxiousness towards, if rates do go up, am I going to be okay? Then it's all leads you down that pathway to say, well, at least with a fixed rate. And we're not talking about having to fix potentially the whole loan. There are options to fix part of your loan, which is great. So, but at least that gives you some certainty. It's obviously a great strategy in an upward interest rate market. So, which is what we've seen pretty much over the past 12 months or so. A lot of people haven't chosen fixed rates, because I don't think anyone really expected rates to go up that high. And by the time we got to that point where we're thinking, well, maybe we should fix, it's probably too late as well. So once again, I just think it comes back to just making sure that it fits your scenario the best possible way. If you want that certainty, definitely an option. So
Absolutely.
And Eddie, what do you think? What would be the main cons to taking out a fixed rate loan in your eyes?
So obviously everything's got a bit of pros and cons, and with fixed rate, there's a few things that you need to be aware of. If you're thinking of fixing your loan, one of them is you don't have flexibility in terms of extra repayments that you can make. So most lenders, they cap it at a certain amount per year, that's the extra contribution you can make towards your loan. So if your strategy is to pay down your debt as quickly as possible, probably fixing your loan is not the best way to go. Also,
just on that, Eddie, if you don't mind me interrupting, you talk about some of them, the banks give you a bit of the ability to make those extra repayments on fixed rate loans. Maybe give our listeners a bit of an idea as to what that cap typically looks like. So they're all very similar, aren't they?
Yes. So roughly anywhere between 5 to 15K per year per mortgage. So depending on each lender and the policy. I've seen a couple lenders come with unlimited extra repayments, but their fixed rates were not the sharpest. So So I guess
if you've got the ability to make those extra repayments, if they're not going to be more than say 10,000 on an annual basis, then it's still not a bad option as well.
Absolutely. Okay. Considering if you're saving a decent amount on your fixed rate and having that certainty, as you said, then it might be worth it. Definitely.
Okay.
The other thing that people need to be aware of is, with fixed loans, you can't have an offset account linked, or at least 90% of lenders do not allow for an offset account to be linked to the fixed loan. So if part of your plan is having extra funds sitting in your offset to reduce your interest on the loan, then having a fixed loan can be not a great option there. So these are the main two things. Few things to be considered, and that would fall under risk, which is always the case when you're doing anything really. So if you fixed your rate on a certain loan amount, you've got a contract like 1, 2, 3 years, and you have to stick to it. So like you said earlier, if rates go down, then you'll miss out on lower interest rates. And if you want to break that contract for your fixed rate, then fees might apply and you might have to be paying a few $100 or $1,000 out of pocket. So you have to be really aware of these things before making your decision. And obviously you need to know what your objectives are. And like you said earlier, 3 years ago when rates were cheaper, 99% of our applications were fixing for 2 or 3 years at 1.8. I was one of them as well. And in the last probably year and a half, we haven't fixed any. I probably had one application with a fixed rate. But it's a very interesting time now because a lot of lenders in the last 2-3 weeks, they're slashing their fixed rate.
To the point where they are cheaper than the variable rates, which is something we have not seen for some time now. So I guess that probably leaned more towards the view that they think rates will come down and hopefully not too far in the distant future as well. So.
Absolutely. Like one lender came with a 2-year fixed 5.69 yesterday. So that's decent. Like I haven't seen a 5.69 in a long time. So it's a bit refreshing.
Who would have thought 3 years ago we're saying 5.69 is a very sharp rate 100%. Where 3 years ago we're talking 1.99 was super sharp rate.
That's it.
Interesting, that's for sure. So
absolutely. But yeah, like you said earlier, splitting can be a great strategy. So you've got a bit of both worlds. If rates go down, you've got part variable that you'll benefit from. And if they don't change or go up, you've got part fixed where you benefit from lower rates. But it's, every individual with their personal circumstances, I guess.
Yeah, and you talk about fixing part of the loan and leaving the other part variable. You know, the variable rate portion is the one where you want the most amount of flexibility, and it does give you that flexibility to repay as much as you want, as soon as you want. And if you end up having to repay it within that fixed rate period, there's no break costs as well. So it gives clients a really good options in terms of what they want to do with their loans going forward. And like, as you say, getting the best of both worlds. So,
like one strategy, which I was doing quite a bit when fixed rates were lower, we would fix the biggest part of the loan, have it on a very good rate. And knowing the customer wants to do those extra contributions, we'd leave like 50Ks or 100Ks in a variable loan where they benefit from having the offset account. And we say focus in the next 2 years or 3 years on paying down that 50K or 100Ks. And by the end of it, they would have paid a decent chunk out of that variable loan and benefited from the variable rate. So that's where strategy comes to place and doing what works for you.
It's where you really need to sit down with your clients and really map out what does the next 2 to 3 years look like for you, which is not an easy thing to do because no one really knows what's around the corner. You know, you can think that you're getting a bonus this year and it's going to continue on, but it may not. But at least having the clients have the option to repay as much debt as they can. So at the end of the day, that's what you want to be doing in terms of non-deductible debt, is paying that down as quickly as possible. So definitely a great strategy to have. And the other thing is obviously if rates are coming down, it gives the clients the ability to continue to renegotiate their current rate.
Absolutely.
And we've talked about it in past episodes as well, where the best option isn't always about refinancing. It can also be around renegotiating or restructuring your existing debt with your current lender, or just going there and renegotiating your rate. So if you're on a fixed rate, well, you're potentially going to miss out, that's for sure. So,
and probably one last thing to end on the fixed versus variable is I've seen some clients trying to take a bet on where interest rates are going to go, and it comes down to like pretty much gambling, like
how does the commercial go? You win some, you lose more. I think it is so.
Exactly. And they were waiting on rates to drop even further to fix their loans back when interest rates were 1.8. And I would say, look, like it can't be any cheaper, like even if it goes down by 0.01%, like you're not going to miss out on much. And they just waited, and they missed on fixing the rates at the lowest time when they were. And that brings me back to work with what you know, work with what works for you now, and think about the bigger picture. Don't think about saving $10 extra or $20 extra or $50 extra. Just have a plan for the next 1, 2, 3 years and work and take advantage of like having a good strategy in place. That goes a long way. So, yeah.
Yeah, 100%, yeah. I guess the next thing is choosing the right type of repayment.
Yep.
And, for the everyday home loan, the choice between principal and interest or paying interest only is probably not as important because most people want to be paying principal and interest. So, but for investment properties, it's obviously one that comes to mind straight away for people. Is like, well, okay, what do I actually do, and what is the best option for paying down debt? Do I just pay as much as I can for the investment property, or do I leave it as interest only? Typically, they'll get conflicting views. The accountant will say, well, go interest only because from a tax point of view, definitely more beneficial. You may speak to a financial advisor, and the advisor will say, well, it's better to build up that equity right from the start. That way you can continue to build that wealth through property going forward as well. So what's something that you would typically say to a client when they're asking you? And I'll probably just lean more towards investment property because that's typically where they have to make those choices.
Yep. Well, look, I try to not be emotional about it and just work on the numbers. And I've had many scenarios in the last few months where people buying an investment property, and like you said, they come saying, the advisor or the accountant or even the buyer's agent told us to have it as interest only and maximize our tax benefits and have a better cash flow. And then when we run the numbers on the difference between an interest only and principal and interest loan, they turn out to be saving $200-300 a month between the two, because as we know, principal and interest repayments is usually lower than interest only. But when you do the difference based on the loan amount they've got, the difference might not be huge. So I would put these numbers with them and say, look, if you want to save $300 a month in repayments on the back of not paying down the debt and building equity, then it's your choice. To me personally, I would choose principal and interest.
Yeah, it's an interesting one, isn't it? Because, over the years, you typically go with one preference or the other, but then you get opened up to why some people go with that principal and interest versus interest only.
Yep.
Over the years, I've dealt with a lot of accountants who have always pushed their clients towards interest only, and it makes sense, yes, from a tax point of view, but, in 5 years' time, that debt is still at that same level.
Yeah.
And you look at it and go, well, yes, hopefully the property's gone up in value, but how much extra equity have you actually achieved out of all that. If you'd been paying down some debt over the time, you've obviously got a little bit more equity. But cash flow is obviously the big thing. Sitting down and working through your cash flow. That's probably the benefits of our group that we work within. They do that cash flow analysis with clients, and clients can actually see, well, my out-of-pocket repayment is going to be X, because typically you're going to be renting out of the property at the same time. So, like you said, for the sake of a few $100s, it may be worthwhile to actually go down that pathway.
Yeah, and that's why it's very important to consider your personal circumstances. So it's not like a general advice here, do this or do that. Like, each individual is different. And sometimes if you've got a non-tax deductible debt, which is your primary place of residence usually, it's better to divert that cash flow or that buffer towards paying down that debt quicker and just leave that investment loan doing its thing. And you're banking on capital gains here. Like you said, you're not paying down the debt, but you're hoping in 5 years, 10 years, that property has doubled in price or whatever, and then you can access that equity and do what you need to do. But me personally, I prefer, if I can afford that little bit of extra repayment to do there, while not compromising my strategy on my personal debt, I would rather be paying that debt down, building equity quicker, because I'm paying down the debt, plus I'm letting the capital gain do its thing as well. So
I guess the moral of the story is, whatever works best for your own personal cash flow.
That's it. So I guess this takes us, Carlo, to discussing some pros and cons for each and things to be mindful about.
Yeah, I think it's good segue, Eddie. The first thing that comes to mind when you're looking at the difference between principal and interest versus interest only, which a lot of people don't realise or isn't in the forefront of their mind, is the actual interest rate. We typically see interest rates for principal and interest loans much lower than interest only. Now, when I say much lower, we're probably talking anywhere between 0.5% to 0.75%. So, but that definitely weighs in. One of the benefits, obviously, of having principal and interest repayments is, like we said, building up that equity right from the very beginning, which can lead to further property acquisitions down the track, and being able to build that property portfolio or just wealth creation in general. So I guess one of the downsides to having a principal interest repayment would be your repayments are going to be higher than if you're paying interest only.
Yep.
Because obviously there's that portion of principal component built into that overall repayment amount. So it's obviously need to keep that in mind as well. The other thing is, which some people forget a little bit about as well, is when you're having repayments on an investment home loan, if you're paying interest only, those repayments are actually tax deductible, the interest component. If you're paying principal and interest, that principal component is not actually tax deductible. So it's something definitely to keep in mind when you're looking at what are the best ways to go with it. So one of the other things I think we need to talk about a little bit as well is the idea of the offset account.
Yes.
And the benefits around having an offset account. You mentioned it earlier on, not being able to have an offset account for fixed rate loans.
Yep.
Probably a good idea to just talk roughly how an offset account works.
Yep.
And some of the benefits. So maybe if you talk about how the offset account works, and we can go through together what some of the benefits
Absolutely.
are.
Hopefully I can explain it. I only explain it 5 times a day. But so it's a very interesting topic, the offset account, because a lot of people don't know how it actually works. So an offset account is basically an everyday account that has an offset feature. And you have that offset account linked to your loan. And the way it works, basically, you've got money sitting in the offset account. The interest on your loan gets calculated on a daily basis, and whatever funds you've got sitting in the offset account, you are offsetting the interest that needs to be paid. So in an owner-occupied loan, it's highly recommended having an offset account. It's another tool that you can use to pay down the loan quicker, contribute a bit more towards your principal, and pay less interest over the years. In an investment loan, it's not recommended if you have an owner-occupied loan, because you don't want to offset the interest, because that's the tax-deductible component. So just leave that interest do its thing. Don't worry about it while you focus on paying down your primary place of residence debt and reduce the interest on it. So that's how an offset account works, and it's a very important tool that I always recommend for all people to use, because you just have your salary directed in there, you've got a bit of savings, you put them in there, and just even if you're saving minimal amounts, it all helps in the long run. So
yeah, I guess when you look at it, like you said, the salary goes into the bank account, which happens to be your offset account. You know, whether you get paid on a fortnightly basis or a monthly basis, you typically have that big inflow of funds in your account, and if you can have that working in your favour right from day dot when you get paid through to when your interest is actually charged, why not? It just definitely makes sense, because the good thing about the offset account, it can be just your normal transaction account, right? It doesn't need to be a completely separate account where you need to transfer money and move money across. And I've seen clients really use it to their advantage, where the money goes into their offset account, their salary, all their expenses they're paying on their credit card. Got to be obviously be mindful of that. But what they do is they have an automatic sweep function where when the actual credit card bill is actually due, the money comes straight out of the offset account, pays off the credit card in full. No interest is paid on the credit card, which is great. And whilst that 30-day period, whatever it might be, the money's offsetting the actual loan, and they're saving thousands of dollars each year. And most importantly, their loan term is coming down very quickly. So it's a great strategy for sure. It is.
And like you said, you've got to be very careful about how to use it, because credit cards can be sneaky sometimes, and before you know it, if you're not on top of your cash flow and your budgeting, it can go out of hand. But that's something I do personally, where I just put all my wages, all the money that comes in the offset account, and just use the credit card, and then you've got 45 or 60 days interest free period. I make sure it's paid off every month, but I'm always making sure the offset account is as packed as possible. Yeah,
you got to be very determined and savvy in terms of how you go about doing or adopting that type of a strategy, because if you miss one of those payments, or you don't have that automatic sweep function in place, before you know it, credit card starts accruing charges and it's not being repaid. So then all of a sudden everything you're saving is being blown out of the water, because the credit card is being charged at 20%,
100%,
and your home loan's only getting charged at 6%. So
100%. I guess one last thing from my end to be mindful about is, if you're doing an interest-only loan, this can affect your servicing a bit negatively. And the reason being is, so you can do 1 to 5 years interest-only term. If you do 5 years term, the bank will do the servicing based on the remaining 25 years, because they assume when that 5-year interest-only term ends, you're going to be left with 25 years to pay down the principal. So the repayments will be higher, which can affect your servicing negatively. So that's something to be mindful about. And sometimes people say, I want 5 years, and then you say, look, the maximum you can do is 1 or 2, so let's do it for over 1 or 2 years, and then we reconsider when it's done. So there's a reason behind it, and that is servicing can be affected negatively. So that's from me, really.
So I guess cash flow, there's obviously some benefits by having that interest only period, but from a servicing point of view and ongoing borrowings, it can have a negative impact. So once again, it just comes down to you really sitting down with your broker and running those numbers and seeing what the actual impact is. Because for some people, there actually may not be an impact, and they might be okay. So
100%.
Ends up being a good strategy. So
absolutely.
Should we quickly touch on borrowing in a personal name versus borrowing in a trust name? And because some people do come to us from time to time and say, I've heard if I borrow money in a trust name, it'll benefit me compared to having it in my personal name. What are typically some of the things that stick out in terms of what are the benefits between those two by borrowing, say, in a trust name versus in a personal name?
Look, I think this has picked up a bit over the last year or two because of servicing being really tight, and people always trying to find loopholes to borrow more. And also there's a lot of property gurus out there promoting these strategies and pushing how to borrow more. There's truth in it, but there's also a lot of bullshit. Okay, so, and you need to be able to differentiate between the two and know what works for you. So I guess in a personal name, some pros and cons. Basically, in your personal name, all borrowing is showing on your credit report. Your borrowing limit caps a lot sooner because everything you've got is under your personal name, and you've got the income to service it all, so you can cap out quicker. The pros of it is it's cheaper when you're borrowing in your personal name. There's no setup costs or ongoing costs. You've got more options to borrow and how to do it, and rates are cheaper. Also, if there's an investment property and there's losses there, you can obviously offset off your taxable income, and it's cheaper when it comes to land tax and fees. So
our favourite topic, land
absolutely.
tax.
So these are the pros and cons in your personal name. Now, when you choose to go down the trust path and purchase a property in a trust, there's a few things that you need to be mindful of. So all the past borrowing that you've got in your personal name will be reflected, and you need to be able to service the new debt in your personal name. Second thing, you might be able to get borrowing in your trust, but you're going to be responsible for those repayments. So it's not just a matter of getting the loan and buying the property. You need to work around, am I able to actually do the repayments? If the property is vacant for 3 months, am I covered? Can I actually afford it? So it's not just a matter of getting the loan, it's a matter of understanding your cash flow and understanding I can actually meet those repayments. So some pros and cons in a trust. The pros, certain lenders can ignore the debts held in the trust, which leads to high borrowing capacity. So you purchase a property in a trust today, and then 6 months down the track, you want to purchase another property in a trust. The existing debt can be ignored, okay? But you need to be able to provide an accountant letter and provide that the trust is meeting its obligations and all that sort of stuff. So that can be a pro. What else? Asset protection is a big one.
Probably one of the biggest ones.
Yes.
For the reason why a lot of people do actually set up a trust is purely for that asset protection
100%.
point of view.
So you've got your personal assets protected in case anything goes wrong. It's just within the trust. One of the cons is actually one of the pros. You can distribute rent and capital gains.
Yeah, I was about to say that's probably the next biggest thing outside of asset protection is that ability to actually distribute to different beneficiaries within that trust. A lot of people have the family trust set up. Mum and dad will be some of the beneficiaries, but then they've obviously got children as well, which they can distribute funds to. Minors can have up to a certain amount from a tax-free point of view. But definitely helps out. You can change that distribution each year as well, depending on what the taxable incomes look like for each of the individuals. So you can definitely work in your favour by having that. But
that's it. And then obviously you're highly reliant on the lender's policy. So one day this particular lender has got a great policy for the trust borrowing, and then if that changes, then you can't do much there.
It's also a lot of lenders who don't actually lend to trusts.
You're very limited with your options. So you've only got a handful of lenders to use. It's costly to set up. Obviously, you need the setup cost for the trust and the trustees, and then you've got your tax returns.
So the ongoing cost can be quite expensive as well.
There's a bit of cost involved with it. It can be subject to higher land tax than individual borrowing, so that's something you need to be mindful about. And the last one would be you can't distribute losses to offset.
Yeah, that's what
income.
Catches a lot of people out, doesn't it? I've heard that before with a lot of people. They go, well, if I can distribute the profits, why can't I distribute the losses?
Exactly.
Unfortunately, it doesn't work that way. But
so immediate tax benefit is not there. But the thing is, you can carry forward those losses to future years, and then when you sell the property, you've made a capital gain profit there. You can offset some of that and save some tax. But I thought it's important to touch on it because it's becoming very popular. We're seeing more of it. It's not for everyone, but it can be a strategy if it works within your circumstances.
And I think if you have the right type of advisors around you, so your accountant, your financial advisor, your broker, having a team around you to work through those strategies and work out what is the best option for you, taking into consideration all the things that we've spoken about today, you'll eventually get to the right decision as such. So
100%. And if you're speaking to the right broker that knows their stuff, they should be able to direct you in the right way. Like if someone comes to us, I would say, these are your options. Go see your accountant or financial advisor to get advice on it and work the best strategy for you. So I think we've covered a bit today.
Yeah, well and truly, it's and you know the whole thing of borrowing in a person name or trust, we could probably go on for another hour,
Yes.
I reckon, in terms of all the intricacies of it. But obviously, just want to thank everyone for listening in once again. Please remember to subscribe to our podcast. Leave us some feedback as well. We're always interested to see what people want to hear from us going forward, and obviously, most important, give us that 5-star rating as well. So. Thank you, Eddie.
Thanks, Carlo.
And I guess we'll see everyone next week. Take care.
See ya.
Bye.
Bye.